Alrighty. So tonight I want to talk about the financial side of the Forex in terms of how the Forex really works, and we're going to have to touch on a couple of topics there. The biggest one being compounding. Now, a lot of you have probably heard of compounding. It is by far one of the main advantages of the Forex in the way you trade. We have something very special in the Forex called leverage. And it's not available as it is in the Forex in other markets. And so you're a little spoiled. We're a little spoiled by how it works. And some of you don't know how it works. You think of it in one way. So I'm going to show you all the ways that it works tonight. The first thing we're going to do to try and stay on track and make this quick, because I want to be fair to you. I don't want this to be a 2-hour class. I might do that on the physiology class, but tonight it's not about length. Tonight it's about the points I make and you comprehending them and then reflecting on your trading. All right. I'm going to give you the facts. Just the facts, man. So let's start with stop loss. So most traders, doesn't take long, probably in your first couple of weeks, you start to learn what a stop loss is. Okay. And so you think of the stop loss as one of the key elements. For sure, don't listen to the guys that say you don't need to trade with one. There might be a point in your career where you go that way, but no time soon. You need to amass a lot of knowledge, a lot of understanding about waveology and how to read the charts, and you're not going to do that in your first couple of years of trading. So always use a stop loss, and whatever your system provider says to use, I would use. That doesn't mean it's great for you. But if you're trading a model, you might as well trade what that model says to use. So in the traditional sense, most people think of a stop loss as something that stops the loss in a trade that's gone wrong. And indeed, a stop loss does that. It does that very well. We don't like being stopped out. No trader wants to be stopped out. But it's a protection mechanism. However, that understanding of what a stop loss is shouldn't stop there. Because what a stop loss really is, well, this is a great feature of the stop loss. When you understand the math involved, you'll soon realize that the stop loss has one of the most important parts to do with your trading. And now again, I'm not just talking about saving your butt on a trade that's gone bad. I'm talking about the stop loss is the profit regulator for your trades. So you have to understand how it's a profit regulator. That may or may not eventually help you decide what it is you want to trade. The reason I was starting to burn out after my first, 12, 18, 24 months of trading, even though I was successful, I told you, I wasn't making a ton of money. Long trades, big trades, going for the big pips, having the big fat stop losses, winning the trade, and barely making any money, especially for the duration of being in the trade. So I went on the hunt, and I went in a roundabout way, and I don't need to give you all that history. I'm going to save you the 6, 12, 18 months of research and just tell you it's in the math of how you regulate the amount of lots you're going to put into a trade. How you do your position sizing. A lot of traders don't know how to do position sizing. Oh, I heard so-and-so put 0.1 lots in the trade, so that's what I'm going to do. not knowing at all the stop loss that changes trade to trade, the amount of capitalization Billy Bob might have on his account when he told you he's using zero point 0.1 or 0.3 or zero point 0.5 lots. You don't just randomly put lots into a trade because somebody else put that number of lots into the trade. You want to work off risk. All right, I'm going to ask Chit Chat not to go on while I'm teaching, please. We reserve the chat box in here only for questions, not chat. You guys could chat outside of here. It's distracting to me and it's distracting to other traders. So unless it's related to what we're teaching, please, no chat in the chat box. So as a profit regulator, well, how does that work? So I'm just going to go and give you the best example if I can with stuff you might be familiar with. And let's look at the harmonic scanner. So here's a scan, and by the way, the harmonic scanner seems like it's been tuned up quite a bit. Okay, I've worked with Jason quite a bit on his work with the programmers, and I think they finally have listened to him, and he's pounded hard enough that they understood. But it appears that the scans are coming in good. So I'm pretty happy about that. So let's look at this harmonic scan on the web scanner. And forget for a moment the kind of scan. Forget for the moment that the D ended up being short of the entry line. Let's just pretend it was at the entry line. Let's just pretend you qualified this and it was a trade. Because I didn't have 3 years to find the exact slide I wanted to really have for this. But nonetheless, you'll be able to follow along. So here's a scan that comes right off. This is my secret alerts. We're going to take this scan just as it came off. Now you'll see up here, bring your attention to, this is the Euro USD, a 1 hour chart. It's a deep bat, but 1 hour chart. So let's bring out a few things about this chart so we understand really what's going on here. If we look up here with the entry lines and the stop loss, and then if we consider this really our entry in this area here, and blow it up just a little to look at it, the stop was set at 124.58. The lower entry line was 124.22. And the D, or an entry on this, if somebody had managed to enter this trade, was at 124.14. 124.14 to the stop at 124.58 is 45 pips. Okay. 45 pips in that stop loss. Now, take somebody that's been a student of mine for a couple of months. They've gone through the Pitchfork course that I give away to IML traders. Normally I charge about $300 for it, worth about $1,000 or more. It's a really good course. I've spent many years being tutored by the best fork traders in the world and bought their books and been to their conferences and seminars and traded the hell out of pitchforks. I wouldn't begin to guess how many thousands of forks I've drawn in my trading career with pitchforks. Thousands upon thousands upon thousands. And I have traders who draw one or two and are trying to trade them. You want to get a sense for what the pitchforks. It's not rocket science, but on the other hand, you don't come out of mama's womb trading pitchforks. But don't let the looks of them scare you. It's an easy tool and they're easy to trade. Most of my traders pick it up after they take the course, which is, I don't know, 10, 12, 13 hours, something like that. It's divided into modules and a couple bonus modules. Free to IML traders. If you saw the screenshot, you'll learn how to access that course as an IML trader. All right. So they can then learn how to put those pitchforks on the charts. And as the scan starts to paint, now on an hour scan, we have a little bit more time. It's not quite as fast as a 15-minute chart. So when you get one of these, big candles, big wick candles that pull back and leave the wick like that, we actually have a little bit of time on the way up. That scan paints at about 91% of the CD move. Well, not at 91% of the CD move, the scan paints. And we have a little bit more time on the 1 hour chart than we do 15. So even on a quick moving candle, that's an hour. There's plenty of time as it's moving up to get into that trade. So let's pretend for a moment that you're able to qualify it. As I said, you entered at 124.14 and you had a 45 pip stop. The pitchfork jar, once they're schooled and they have a little understanding, can come in and draw their pitchfork. Now, I know this is going to look a little Greek to some of you who have never studied pitchforks, but the circles represent touches. And so what happens, this is called a best fit pitchfork. We don't have a swing high to, a swing low to go back to. And so, well, we do, but doesn't have the shape that I want. So this median is just moved up and down until you get maximum touches on this fork. So we can say I'm here in real time. The scan just painted. I could put this fork on and move this up and down to get touches. We like to see touches on the outside, on the median, and on the other outside. But if we have a couple of touches like this one here and this one here, the incidental touches that we get off these other lines, which are called Fibonacci's, they mean something. So I got double touches here. This was 2 touches. Got a nice touch here. You could just follow the circles. There's a nice touch to another Fibonacci. Here's a touch, the C on the bottom. So think about that. We got an outside touch and an outside touch. That's really good. That qualifies this fork. Okay? I'm not sure right now what the tab 29 indicator has to do with what I'm talking about. So please pay attention to what I'm talking about. It's just that simple. It's manners to and respect to the other traders in the room, not to be distracting them. Okay? So I have this pitchfork on here in alignment. It's good. The angle's good. And what I want you to see down here now, a couple of things. One, on the right-hand side, from 123.20 to 123.30, we have a 10 pip channel. The price channel, not the trend channel. So the price scale channel, I adjusted it to be 10 pips. So we have a 10 pip channel. We've got the fork in alignment. We've got our entry lines. Price might have gone up to this entry line. It might have gone into the entry line here. Might have taken a few more moves to get up to here. That would have been a nice trade. The entry line and the pitchfork. Doesn't matter. This was the fork. It's in alignment. We validated it with 2 nice outside touches. Lots of other touches inside. This is a qualified pitchfork to trade. Price force, the scan proceeds to move up in price. The D hits this Fibonacci. Now, normally we don't take a trade just off of Fibonacci. But we did something here called a fork Fibo. We measure the distance from the top of the swing to the bottom, and we do an extended retracement off that, meaning we're at 0 down here. Oh, there's 23.6, there's 38.2, there's 50, 61.8, blah, 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 blah. 100% line. Everything beyond that is extended because it's extended beyond 100. We can see where 161.8 is, 176.4, 190.2. Looky, looky, looky. 200% of this swing to the pip intersects this fib and L. That's called an energy point. And any of my pitchfork traders know energy points almost always have what after them? What occurs after an energy point almost always? I want one of my students to type it in there. What kind of move? Yeah, a huge move, a big move. What do we typically call those moves? What kind of move? It's a woo-woo move, yeah. It's an impulsive move. It's an impulsive move after an energy point. We have the 200% Fibo. We have the diagonal of the fib and L. And price starts pulling back from it. You bet we're in that trade. As my old training partner used to say, in there like swimwear. Yeah, absolutely. Impulsive, 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 impulsive. And what happened at this energy point? Impulsive move. Now, come back to scale. One thing we know about our pitchforks, when we have an energy point, they're either going to be overrun big time or they're going to reverse right there. So we don't need to worry about big fat stop losses. I've drawn the stop loss as this red line. Look at your scale. Who wants to guess about how big that stop loss is? From that fib and L up to that diagonal line. It's about 10 pips. An energy point is where you have a diagonal of the pitchfork intersecting another horizontal line. See, there's only one candle that can hit that point because it's an intersection. The 200 by itself, candles can come up and bang off that thing dozens of times. Any one of them, right? Only one candle can hit the 200 and that diagonal of the fib and L at the same time. Don't worry about how to set this all up. That's not the purpose of what I'm showing you here. What I'm showing you here is we use pitchforks to bring precision to trade entries. And so this energy point allows me to take this trade even before I would normally qualify it because the entry lines are out of sight. They're beyond where I am. So unlike quickfire where you have to touch the line, we don't have to touch the line with pitchforks and energy points. Yes, thanks, Brad. It's about a 10 pip stop loss. It's about a 10 pip stop loss, which is important to understand because now we're going to segue into something else so you understand what's going on here. So I'm going to go to Trade Calc, which is a program you have access to through that screenshot I told you to take at the very beginning. If you were here on time, you got it. If you were late, you want to be on time. So now we're going to jump to Trade Calc and look at these two trades. So let's look at our first trade that was based on the scan. Now there's 4 variables to determine how many lots you're going to put into a trade. You have to know the value of the pip for the trading station you're on and the pair that you're trading. All USD pairs are typically $10, $1, or 10 cents, depending on the standard mini or micro account. So let's just say 10 cents here. We've got 5,000 in the account. We're going to put 2% risk into the trade, and we have a 50 pip stop loss. Guys, I'm not teaching pitchforks. The pitchfork was illustrative of how we can take a trade when the criteria is selective to us. The point of the pitchfork is that a 10 pip stop loss is way more than adequate for the precision that we have. Let's not worry about anything else about pitchforks. You can learn that in the course, and you can learn that by coming to these sessions outside of these special classes that I'm doing for 5 weeks. So these 4 requirements, these 4 variables are what's needed all the time to do fixed percentage risk. I'll get it right yet. Rewind that tape. Fixed percentage risk, which is how IML trades. When you look at your scanner and it tells you all the key points, the stop loss, the entry points, it goes through these same calculations. If you watch the pinned videos in the Scans, Forex, and Fibos group, you'll see that, where I show side by side the scans, the percentages, how IML calculates the risk, and eventually the number of lots to put into the trade. It's not random. You don't just put in X number of lots because Billy Bob did. So when we crunch these 3 variables that we know into the trade, it'll tell us that we could trade 20 lots. If this trade, where we have a 50 pip stop loss, is in place, goes for 100 pips, we could put any number we want in there. If it goes for 100 pips, this is what happens. We had 100 pips in movement. We had 20 lots in the trade, so we have an equivalent of 2,000 pips made. And at 10 cents a pip, that's $200. We had a 4% return on the trade. Also, those videos will teach you whatever you put into your stop loss, that stop loss then becomes a percentage gain maker. In other words, if I have a 50 pip stop loss and I put 2% into it, that means if my trade gets stopped out after negative 50 pips, I get stopped out, I lose 2% of my account. On the flip side, there's my stop, minus 50. Here we are at 0. On the flip side, if that trade goes up 50 pips, I made 2%. Because it's 2% to a 50 pip stop loss, it works the same way on the gain. When I get up to 100 pips, it's another 2% for a total of 4% gain. So the stop loss is the regulator as to the profit. All right, so I don't know if I have this edited for the right, we'll see. So I edited this for our trade. We had a 45 pip stop loss. Same parameters up front. I got a micro account. I got $5,000. I'm putting 2% risk into my trade. I could trade 22.22 lots if I have a 45 pip stop loss. If it goes 100 pips, I made 4.44% return. Now, the pitchfork trade. Same parameters, guys. We still have the same value of a pip. We're trading the same account. I still have the same $5,000. I'm going to put 2% into my stop loss, but it's a 10 pip stop loss. And here's the data. Over here, where I made $222, here I make $1,000. Same starting account, same downside risk in the trade. The difference was the size of the stop loss because of the precision that we have. And so I'm making just a few dollars short of 4 times the profit. Same trade, same downside risk, same size account, 4 times the profit. Is everybody with me? Well, if you don't understand how to do lot position sizing, that's something you need to learn. That's not what we're going to learn tonight. That information, as stated, is in the videos in the Scans, Forex, and Fibos group. It explains risk in trading. So if you don't know how to do how to do position sizing, you got to learn that before you do anything else. It's pretty simple. You've got to learn how to do position sizing. I use the exact same numbers and methodology that IML does. And in those videos, as I've said, I show it side by side. And the scanners are the best way to do it because they had well, at least the MT4 one. The videos on risk that I have are available free to you in the Scans, Forks, and Fibos pin post. Zoe, Theo, Tim, somebody that's here, would you type that out and cut and paste it so every time somebody asks where it is, you could just paste it again? Guys, I'm going to get grizzly because I'm here to help people, and we're getting, questions off topic that I've already said where the answers are to it. So that'll bring the grizzly out. All right. So what we see here by looking at commonality, the commonality being a scan that comes up on your MT4 or web-based scanner that you want to trade. You manage to qualify it, you get in, you have a 45 pip stop loss. It tells you how much risk to put into the trade. And there you go. So we can also trade that scan with a pitchfork where I only have a 10 pip stop loss because of the precision that we have. Because the quality of the fork, the scale, the tight stop loss that we can have. You don't have to understand how all that works. That's for you to learn. You need to learn pitchforks if you want to have precision. If you want to make 4 times the profit. Guys, let me tell you what 4 times the profit means. Trade for trade. First trade, they're making X and you're making 4X. No pun intended. The next trade, they're making X and you're making 4X, except these are compounding along the way. And the next trade, they're making X and you're making 4X. And the next trade, they're making X and you're making 4X. And the next trade, they're making X and you're making 4X. Let's say X was just $100. So at the end of their 5 trades, no compounding involved, they made $500. If X was 4, you made 400, 800, 1,200, 1,600, 2,000. Still 4 to 1. But the magnitude of the dollars starts totally drifting away. All right. But the difference is these are going to compound at much higher rates. All right. So anyway, I've given you an understanding of how precision is very real. I just showed you a scan trade naked and a scan trade with a pitchfork. Okay. And I showed you then the difference in the reality of when you make 100 pips or 200 pips or 50 pips. It's still going to be what? If it was 45 pips to 10, I'm going to be making 4.5 times the profit in every trade. And that compounds big time. All right, let's think of the penny doubling story for a minute to set the tone of where we're going to wrap this up. And you all, if you haven't ever done this, it's a fun exercise. And some important information from here, which again will carry over to our physiology class, is what an exponential curve looks like. And what's happening is all the work's being done in here. All the work is being done here. It's just not visible. It's just not visible. Yeah, there's actually a slight angle to that, but not when you scale it at $6 million which was the day 30, 5,368,000. When you scale it there, you just don't have room for the 64 cents and the $40.96. But that's the reality of trading. And this is why people burn out of the old paradigm, because even though they're winning and even though they're making money, it just can't grow but so fast. It's limited in its growth. All right. So it's not until the 7 last 7 days, you go from 41,000 to 5.3 million. And you're going to see how this happens in just a second. So we're going to go to a side-by-side calculator that I have. And don't ask if you can have it, because I don't give this away. Not yet, at least. And the first thing I want to do, so you don't think this is jury-rigged or fake or something like that, is I want to take a look at another industry-wide calculator that'll prove the math that here is right. Why do I need another one if there's another one I can go to? Well, you're going to see here in a few minutes, the other one can't do the stuff that we do. So let's just talk about this 1% gain per trade or per day. Doesn't matter which one we want to use. We'll pick one or the other. So 1% per day gain. So let's figure out what we do here. This calculator, the way I did it is pretty simple. I just took 1% and compounded it each day with the same earnings. All right. But the earnings grow because they get compounded. So let me just take you to this other calculator for a second. Einstein said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Absolutely. All right, so let's set this up like we would our calculator. And we're going to look at $5,000 in our account. And we're going to look at our daily return of 1%, as I said. Let's just look for 15 days because I want to be able to show you rapidly. Daily reinvestment rate. In other words, I'm not going to take anything out that I make. So the daily reinvestment rate is up. It's in the way here. Is 100%. And I'm not going to include weekends. Calculate now. It does its calculations. It shows them below. And what you'll see is, and bring your attention to this, if somebody wants to write this number down, please do. After 15 days with $5,000 in the account, with daily interest of 1%, reinvesting 100%, our account balance is $5,804.84. $5,804.84. So let's now go and put those same parameters in our calculator. We're going to have a $5,000 balance. We're going to make 1% per gain. And let's just look down here for 15 days. $5,804.84. So my calculator equals what, Compounding Daily's calculator yields. So I wanted to just show you that so you understand there's no trickery here. So it doesn't matter how you get your 1%. It doesn't matter how you get your 1%. For us, in what we do as precision traders, is we're going to use a 10 pip stop loss, and we only need to make 5 pips per day. Now, there's a lot to go over with this, but you'll see both of us earn 1%. And so in stop loss number 1, I should have put this up so it repeats itself. In stop loss number 1 here, we're making 1% a day. Stop loss number 2 here, we're making Wow. 1% a day. And so you'll see all these numbers match. 9,083, 9,083. Now what you want to see here is something that's pretty spectacular. First of all, if you're trading with a 100 pip stop loss and you're making 50 pips a day, you are making that 1%. If you're trading with a 10 pip stop loss, all you need as a precision trader is 5 pips a day. Nonetheless, it's 1%. Now, here's the interesting thing. 5 pips a day, because I can use precision trading and tight stop loss. 5 pips a day. Let me ask you a simple math question, even if you haven't been trading that long or studying to trade that long. How many 5 pip trades a day do you think there are versus 50 pip trades a day for the pairs that you trade? You'll stop entering for a second. Stop, stop, stop. Don't enter anything right now. Don't enter anything right now. It's scrolling and I can't keep up with the questions. So just hold on a second, please. You're not risking the same dollars per pip. You're not risking the same in the 45 pip stop loss. You're risking 4.5 times less. It's just stretched out 4.5 times farther. It's the same. 2% is 2%. If I get stopped out at 10 pips, I lose 2% of my account. If you get stopped out at 45 pips, you lose 2% of your account. The difference is in the gain. So when I gain 10 pips, I make 2%. You have to gain 45 pips to make 2%. It's in the movies. I don't want to spend time here. It's in the videos at Scans, Forks, and Fibos. And I spent hours explaining it. So I'm not going to answer it here because I got about 5 minutes that I really want to get through this. Trust me, I didn't just come out of mom's basement and been trading for 2 months and am here teaching you. No, it's totally wrong. It's totally wrong. It's totally wrong. So, I'm showing you right here. I don't understand. I just proved this calculator works. You're trading a 50 pip stop loss, you make 100 pips. I'm trading a 10 pip stop loss, I make 5 pips. We're both making 1% on our account. Period, end of story. Do the math. So let's say you can find 50 pips a day with your 100 pip stop loss. You can actually achieve that 1%. Paradigm shift has nothing to do with simple math. Paradigm shift has nothing to do with math. Math is math. That's cool. It's a universal thing. And when you apply the same math to both, pretty spectacular differences. So here's the cool thing. 1% a day. If you trade 23 days a month, there's 26 trading days for just about everybody. If you trade 23 days a month, 1% a day, and it's compounded, at the end of 24 months, you have $1 million in the bank. If you trade every available trading day there is, at the end of 24 months, that's $2.5 million. No, you're not using the same lot size. That's using the same lot size as a Forex trader is the most foolish thing you can do. You've been blessed with margin and leverage. No other financial market has anything close to what the Forex has. If you put in the same number of lots every day, as your account grows, you're trading less percentages as time moves on. You're no longer trading 2%. You're trading 1.99, and then the next day 1.98, and the next day 1.95. Eventually, you're down to you're trading like 0.2% of your lot because you're still trading the same number of lots. You want to get used to not watching the trading station and just trade the same number, the same risk in each trade. 2% is 2%. You want to take advantage of that. If you're afraid to take advantage of that, you're going to remain a generalist and part-time hobby income. You'll never make job level income. Yes, that's what happens. You have larger lot sizes, the smaller the stop loss. The difference is we're going to have very high percentage success. So it's kind of like a double positive whammy. Watch the videos. Thank you, Tim, for reminding them. Watch the videos. I'm teaching you about compounding. So here's the thing that you have to understand. If I can make $2.5 million in 2 years by getting just 5 pips a day, you're not sitting on charts 12 hours. All you have to do is make 5 pips a day. So here's the interesting thing about all this relationship. Here's what it comes down to. Some of you aren't going to like hearing this, but I'm just told you. I'm here to tell you the facts. How these calculations work is proven. I showed you with an outside commercial vendor calculator that our math is exactly the same. So there's nothing hypothetical about the math. Math is math. There's nothing hypothetical here. The hypothetical part is, can you make 5 pips a day? And let me tell you this, if you can't make 5 pips a day, you're not going to make 50. If you can't make 5 pips a day, you're not going to make 50. So, if anything, this has the hypothetical part of it. But again, once you go through the pitchfork course, you'll understand that 5 pips is kind of a joke. But nonetheless, $2.4 million, $2.5 million in 24 months. Now, here's the thing. Why doesn't everybody achieve that? I'll tell you why. It's for this thing called RAS, and we're going to talk about that in the physiology class in 2 weeks. Because here's the reality. People laugh, oh, 5 pips a day, I can make 5 pips a day. They get their 5 pips, and what do? They stay on the charts. Their ego gets involved. What ends up happening is the amygdala gets flooded with emotion because of adrenaline and endorphins, and the amygdala shuts down your RAS. The amygdala is there to guide emotions, and in its function, it shuts down the RAS, which means you no longer see the charts the same way. The incoming information is processed differently. Come to the physiology class. I'm not going to teach it tonight. So they keep trading. But right now there's a disconnect because some of you are thinking, 2.4, is this guy high? So you believe you can make 5 pips a day, but you don't believe $2.4 million. And interestingly enough, you've got it backwards because this is the hypothetical. This is the actual math. The reason you're having a struggle with $2.5 million in 2 years is a psychological thing in your subconscious. You don't believe you deserve it. You don't believe you deserve it. So 5 pips a day is all you need. Now, let's look at something because I'm going to show you a few things. There's some IML traders. It's not as blatant as it used to be, but there's some IML traders, mostly IBOs, because they try and use their trading as a recruiting mechanism, i.e. emotional enticement. Looky, looky what I can do. And they used to brag, some of them still do, about their withdrawals from their account. Oh, you ain't a real trader unless you can show me a stack of $10,000 withdrawal slips. They might have some swag, but let me tell you, they don't understand math at all. And I'm about to show you. But first, let's understand that exponential curve and that there's a couple realities to it. And the first one is there's really, in a generalized sense, there's really 3 exponential curves that are involved. One we'll call the normal growth. Now that is for whatever you're trading, whatever stop size you're using. I just want you to disregard the fact that if this is an old paradigm system with the larger stop losses and the new paradigm is going to be green, the new paradigm slope is going to be like that. So that would be the norm for the new paradigm. But I just want to generalize this for where we're going next so you understand more about compounding. Let's just say that's the norm growth. Fairly linear. You can do things to slow your growth big time. And you could do things to accelerate your growth big time. So let's look at that. And I'm sorry these screens got a little shaded. It was something else was being mixed with and I ended up saving the wrong files, but you could still see it. So about, 60, 90 days into your live trading career, your girlfriend, your fiance, your wife, whomever supporting you, or vice versa, your boyfriend, your fiance, your husband, and they say, honey, I've been supporting you all this time. I really need a vacation. You've been doing great. Can we take a little vacation? And of course you want to, hey, oh my lordy. Zoe, Tim, Theo, I need my tequila. The whole point about if you make 5%, you don't want to keep trading. The whole point of precision trading is, first of all, we don't lose 1%. I know that sounds a little arrogant, but once you understand what precision trading is, you'll get it. First of all, we rarely, if you saw at the beginning, we rarely exercise our 10 pip stop loss. It's an emergency stop loss only. Most of the time, we're out of there within 3 pips because it's either turns or it doesn't. That's what precision trading is. And if it doesn't, I'm out of there because it's not a wave 1-2 and I don't need to be involved in extended runs against me. So most of the time, we're out of there at 3, maybe 4 pips, depending on your spread. So first of all, in a 2% trade, we never lose 2%. The most we lose is maybe 0.7, 0.8%. So it's hard for us to do that. And we're not a 50-50 system. We don't have to win 2 for every loss. It's not like that. With precision trading, all you care about is, you'll see it in the summary, is very high percentage runs. Watch the videos, you'll understand. So here we go. How much is that guy worth? Right now, I'm worth every penny you paid for it, which is 0. Right now, I do private coaching for $10,000 for a 5-day boot camp at the person's site. Right now, I haven't worked a job since 2004. That includes, many years putting my kids through school all the way to their PhDs at $46,000 a year. Hey, anybody wants to have a trading contest with me, I'll be glad to do it, my friend. We'll set the criteria and we'll run it. Nobody has to be here. You could go to any other session you want. Listen to the traders that are telling you what goes on. Why do you want to withdraw $800,000 a month? Anyway, honey, I've been supporting you on your let's take a vacation. $1,219 each, all expenses paid, including airfare to the Bahamas. $2,500 a couple. All right, so that was what? Day 90, day 60, let's say day 90. So day 90, I pull out $2,500 from my account to take my sweetie on that Bahama trip because she's been so supportive. Just one, $2,500. Now watch this. Think about all those traders that were bragging about their $10,000 withdrawals. Watch this. One $2,500 withdrawal. Remember, these accounts are the same. They're compounding at 1% each. 1%, 1%. I just lost, at 24 months, I went from $2,486,000 to 1.9. I lost $500,000 for my $2,500 trip. See, that's negative compounding. This is how you have to understand how compounding works. One $2,500 withdrawal cost me $500,000. That's not enough because we go on a little further and she continues to be supportive. He continues to be supportive. And now, honey, I think it's time for the engagement ring. If we look at national norms, I'll just look at the U.S. I don't know about other countries. Typical guy making $45,000 a year. He's advised to spend $7,500 on a ring. I'm not an investment advisor. I cannot recommend, refer, or endorse brokers because it's considered investment advice. And if you put your money in a broker and they go under, I don't want you suing me because I told you which broker to use. And trust me, people do just that. Oh, that wouldn't be me. Yeah, well, I'll tell you what. You put up a bond for $1 million or $2, then I'll tell you who my broker is. So $7,500. So let's wait until, I don't know, day 120 into this 120 trades, 120 days without weekends. So we're going to spend $7,500 on that engagement ring. Now you'll note the math is convenient. I didn't make it that way, it just came out that way. $2,500 for the vacation, $7,500 for the engagement ring. I've pulled out of my $5,000 account where I started making good earnings on 1% a day. I pulled a total of $10,000 out of my account. And look at what happens. Still making 1% a day, still compounding, still making 1% a day. Nothing's changed between trade number one, trader number two. 2.486 million to 848,000. You went from $593,000 if you, I can't use that. That's 20 days. I went from 2.486 million to 848,000. So about what is that? 400 short, about 1.6 million. Because I took out $10,000. So these guys that are bragging about the numbers of $10,000 withdrawals that they made, I hope you see the math. There's lots of things you'll do. You'll split brokers. You'll start trading directly with a bank. In the U.S., several of the banks will allow you to trade the Forex and not have to buy dollars and exchange them for euros so you can change euros against dollars. There are banks that have it automatically set up. You could trade the Forex with them, ECNs, and they're not subject to Dodd-Frank. They're not subject to, in the States, FIFO. They're not subject to no hedging because the banking industry is regulated tight enough that the CFTC says the banks are good enough to do whatever the hell they want to do. So as a trading through a bank, you're not under the regulation of the CFTC or the NFA, which is all pretty cool. And you can set up that account so it's just like any bank account. It's just you're going to trade Forex from it. So in the U.S., it's insured up to $250,000. I don't know any overseas brokers that'll insure every one of my accounts at $250,000. Not as a U.S. citizen. So most of the time when you get, to certain levels, depending on the bank, the minimum requirement is somewhere between $25,000 and $50,000 as a deposit. So you want to get past that before you do that. But for sure, you don't want to run up your money too much in any account. This isn't a practical session on applying good sense for banks. Though, I hardly saw any oohs and ahs, and I'm quite surprised that everybody automatically seems to already understood the impact of compounding to the negative when you pull money out of your account. So what does that say? A lot of you who immediately change your job, I want to quit my job and be a full-time trader. Well, if you're going to pull money out to satisfy your job, you've just traded jobs. You're making money and pulling it out. You're making money and pulling it out. You're making money and pulling it out. The whole concept of, my team's going to eat tonight. Oh my gosh. Go make $50 and pull 50 out to buy pizza and beer. That's how you make a lot of money. That's how you achieve financial freedom, is by spending the money as you make it. So the ideal thing for a trader to do, let me hit the mistake. The mistake is to pull money out of your trading account. That's the mistake. You'll never get wealth. You'll have job level income. You'll never get wealth if you pull money out of your trading account. And so you want some sort of passive income, whether it's a JOB, suck it up, 6 months, 9 months, a year, 18 months more if you're going to get to the point where you can get this. You want something, ideally, that will pay your living expenses, have a comfortable lifestyle, and in the U.S., this is big, pay the taxes on your earnings, so you don't have to pull money out of your account to pay your taxes. So you want something that will give you your expenses plus the tax on whatever that income source is, plus the taxes for your earnings. Now, I'm not going to do a sales job because I'm not going to benefit from this because you guys, 99.999% of you are not on my trading team. So I don't benefit from this, but let me tell you, Christopher Terry, Isis, Alex, Jason, Brandon, and now the number of Chairman 100s is growing, and 50s and 25 is growing. But, oh my God, what a vision and opportunity they've given you, and on the IBO side. Because now you have a way of making money so you don't have to pull money out of your trading account. Not saying it's your game. I'm just saying it's cool to be able to have a business. I mean, what are you going to do? Set up a soap business? Go to another MLM and sell shakes? Flip real estate? What are you going to do? Or keep your job? Yuck. So, bottom line, my recommendation, not investment advice, but my recommendation is you have to understand this compounding. This was the big reveal. I don't care if it's off by a magnitude of 10. Every dollar you pull out has huge ramifications because of compounding. Now, let's look at, and this is going to be crazy, but again, the numbers don't lie. This math is real. I've proven it to you with other calculators. 5 pips a day. What if instead of the $2,500 withdrawal for the Bahamas trip and the $7,500 withdrawal for the engagement ring, what if at the end of every month, give me a few minutes to do this, I'll just do maybe 6 months, you put in $500 to your account from whatever passive source you have. So you didn't pull anything out, but you're actually adding $500 a month of savings because look, guys, 24 months of sacrifice? Are you kidding me? Oops. $120. I think that's 4. You got to wrap this up. $120, $150. So for just 6 months of contributions of $500 a month to my trading account, on top of everything else that I'm doing, let's get the 180 in there. And just like the withdrawal kind of blew my mind when you understand it from a capitalization standpoint, wow, keep overreaching. Let's look at side by side, same 1% a day. I put in, 6 times 5? $3,000. And my account went from 2.4 to over 3. So $510,000 worth of growth from $3,000. People want to talk about leverage in your financial world. You're still pulling out. Doesn't matter where you get it from. If it's coming from your trading, whether you put it in one account or another, it's law of association. You're still pulling it out. So adding, huge ramifications as well. So the bottom line here is you've done your reading, well, you have a norm which occurs. It affects all your life: finances, health, business, personal development, relationships, Forex. And what's uncomfortable early becomes comfortable later. Keeping my expenses down, not pulling from my account, not spending money frivolously. Not easy up front. There's some sacrifices involved in that. But then you got $2.5 million in your bank, all of a sudden you're a little bit more comfortable. Works the way, same way, but in the opposite direction as I showed you. If you're going to be a victim, if you're going to feel entitled and not do the work because you're so content and you have being comfortable now as an imperative, down the road, you're going to be very uncomfortable. But it's this search for being comfortable now that leads to the failure. And as it says here, that lasts a lifetime. The 5% that make it exercise the discipline early on, do the sacrifices. They are definitely uncomfortable, and then they become comfortable later. Yes, that is Jeff Olson. So, in conclusion, I'm going to say this. 50-to-1 leverage is just fine. You don't need to stay up for the London session. You can if you want to. You don't need to hunt for big pip trades. If you want to, that's your game. You don't need to use huge risk in your trades. You don't need to overtrade. You can have a lifestyle. Fewer trades needed for good ROI. 5 pips. 1% a day. The fewer trades that are required, the more selective you become. You don't have FOMO. You don't have desperation. When you need less pips in a trade because you have precision entries, you can be much more selective. Somebody asked, would you take that trade if it was an energy point? Hell no. I'll wait for the energy points. I don't need to take lottery ticket trades. If it's bouncing on the upper parallel or the median or the lower parallel, I'll take it. But if it's a fib and L, if it's one of those lines in between and it's bouncing there, I'm not taking it unless it's an energy point. I can be selective like that because there's enough of those energy point moves. And they're so high percentage. That's why I pointed it out. Whenever you have an energy point, it moves that big impulsive moves. And it sure as hell ain't 5 pips. The more selective you are, the higher percentage of wins. If you don't have to take lottery ticket trades, if all you take are the pristine trades, like I tell my traders, and many of them are already experiencing this, we don't take a trade, we're not going to win. That's the kind of selectivity you can have. The higher percentage of wins, the less the losses mean. If I'm winning 85-90% of my trades, and I get a loss, I know it's just a distribution. It's just, I'm going to lose 1 out of 10. Fine. It's no big deal. Go right back. The loss means nothing because the wins are so highly profitable and the percentages are so high. The less losses you have, the happier you are. Happy trader with a happy lifestyle, with a great lifestyle is achievable. That's the new paradigm. So now you understand how that all works. Somebody mentioned it, so I'll just tell you, if you have not yet read both these books, you need to get them. Compound Effect by Darren Hardy, former publisher of Success Magazine. He's got so many programs out. He's just like Tony Robbins, just maybe not quite as well known. And The Slight Edge by Jeff Olson. They both talk about compounding. They come at that elephant from slightly different angles. So if you haven't read them yet, put them at the top of your list. Twin trading is nothing more than legging down. I could enter 1 trade and exit 50%. It's the same as entering 2 trades. It's the law of association. If you prefer to twin trade, it's the same thing. I enter 1 trade and I leg down. So I want to introduce you a concept on the self-development side, it's a Facebook group. It's called the Whetstone Book Club. Um, it was started by one of my traders, and I encourage you to go and join. Whetstone is used to sharpen, hone, and improve the performance of metal cutting tools. There are many types of whetstones. Their shape, structure, composition, and skill required in order to get the most out of them. The word whetstone is pretty cool. Bottom line, the goal here is to read and to do a book summary, volunteer book summary after you read a book. And this is what a typical book summary looks like. The vast majority of these book summaries come from a group I have, and we're kind of merging these two groups. But right now, there's over 300 summaries as of today in the Whetstone Book Club. And they're really good because these are all traders. These are all traders. And when a trader says, if I could give it higher than a 10, I would. Well, that's a book I want to put on my book list. And so when you go in there and see 300 already, you get some ammunition. People say, well, what book should I read? Well, there you go. Go join Whetstone. Don't just join it to suck value out of these summaries, because people took time to do it. People read the books and they wrote the summaries. Join so you can contribute too, and we make this something pretty special, right? All right. So, in conclusion, I hope you understood something about compounding tonight. Some of you questioned some things. That's okay. You need to catch up by reading the videos, watching the videos at iMarkets Live Scans, Forex, and Fibos. And you'll see for yourself what goes on. And one final comment just on head game stuff. I can tell you this. There's always a percentage reality to what we do. Always a percentage reality. Any given day. If you have a system that's 80% wins, by definition, that means, as you would see it, it's different in the new paradigm, you would see it as that means there's 20% losses. So here's what will happen to traders, and I know this because I've coached thousands and thousands and thousands of traders over the last 15 years. When traders bring to me the exceptions, well, I took this trade and I did it exactly like it was supposed to, and it didn't work. And I say, congratulations, you found one that didn't work. Now, go find the ones that do. What happens next week? They come up with another loser. So they start programming their RAS, and they law of attraction. They are their own future makers. They are their own self-prophets. And it's a psychological condition because they don't want to try and succeed because they're afraid of failure. So all they want to do is point the stuff that doesn't work. And I'll just say this, several of you were doing that today. You weren't even listening to what I say. You're talking negative on the concepts without having watched the videos on risk, without having watched the why you might want to consider pitchfork videos. And you're looking for the stuff that maybe is the stuff that might not work. What's more important, and the traders that take off and really succeed, they focus on the 80% that works. They don't worry about the 20% that doesn't. It's a truism in life. Take it to relationships. If you're going to find the 20% things that are wrong with your partner, that relationship is doomed to fail. Doomed to fail. Instead, focus on the 80% that you should be blessed to have in a partner. And focus on that. See, this 80-20 thing, or 85-15, or 90-10, doesn't matter what it is. Some people have a propensity to go after the negative part and to bring focus to it. They're going to get more of what they put their energy into. What you focus on, you get more of. So turn that around. Go for the stuff that works. Not, well, what if this happens, and what if that happens, and what if it's a total lunar eclipse and the wind's blowing from the northwest at 18 miles an hour and blah, 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 blah. What if? Go do the stuff that is 80%, 85%, 90% all the time. Well, 80-20 is called Pareto rule, but that's a different application of what we're talking about. These people are what we call exception hunters. And they're never going to get, you're not going to get anywhere as a trader as an exception hunter. And I'm not bragging, because I'm not that kind of person. My ego was hung up on the shelf many years ago. That's what you have to do in order to be successful in trading. But it's just ironic that people have been in it 3, 5, 6 months, and they're telling me how the math works in trading, with me having traded 15 years. Jason Brown recruited me over a year to be an educator at IML. Recruited me over a year. Every couple of weeks, phone call. You going to do it yet? You going to do it yet? You going to do it yet? We need you. We need you. We need you. Chris Terry wants to partner with me on some projects. That stuff doesn't happen because I've been at it 2 months out of my basement from my mom's house. All right. So go to Whetstone, join Whetstone. It's good. And the last slide, if you haven't already seen it, I encourage you to take a screenshot. This is the schedule. So coming up next week, all sorts of big giveaway and the training on all those indicators. And I got some really special ones. The following week, we do the Trader's Physiology class. And I'm telling you, I don't care where you are in your trading, from thinking about doing it, you just joined IML yesterday, or you've been trading 5 years, you want to see this session. There's stuff I've never revealed in this session. Not directly. My traders will recognize it, but I've never told them it. It's pretty interesting. And then lastly, the master class on Fibonacci, May 9th. Again, all the magic numbers you've never seen, probably never find. I'm going to give that away. And a strong case of how to use Fibonacci in your trading. That includes retracements, extended retracements, projections, expansions, fork Fibos. So lots to go in the next several weeks. Hopefully you got something of value and content tonight. Sorry where I got a little grizzly, but I just like normal manners and polite manners. And when our guest attendees don't offer that, then the grizzly will come out. I'm trying to work with Jason to get an ejection button. And so when I get it, we can eject him from the session permanently or just for the session. All right, that's it. So I will remind you in my closing, attend these sessions every Monday, Wednesday on the Forex side, Tuesday on crypto. It's the same stuff, whether it's crypto or gold or Forex, pitchforks or pitchforks, Fibonacci's Fibonacci, harmonic scans are harmonic scans. We got a harmonic scanner coming out for crypto. It's going to be traded the same. There'll be quick fire for crypto. Oh, it's the same system. Pitchforks for crypto. No, it's just a pitchfork. Technical trading is technical trading. So if you want additional juice besides Monday, Wednesday, come visit us on Tuesday, just an hour earlier. And with that, I'm going to say good night. Remember, life can be short. So for those people you love and care, let them know you love and care them. I appreciate that you took some time out tonight to be here. Hopefully I didn't get too strong and chase anybody away. Hopefully you'll be back every Wednesday for the next 3 weeks, and we'll get through the spring series of training on steroids, and we'll be here every Monday doing the same thing we always do, talking about the new paradigm, looking at the various pairs, pitchforks, setups, and trades. Y'all have a great night.